Good morning, everyone, and welcome to the Daily Hunt for Multi-Backers. It's Friday, December 5th, 2025, and we're excited to wrap up the week with some fascinating market commentary based on yesterday's data.
That's right, Ethan. Our AI dug through a mountain of social media discussions yesterday, flagging quite a number of different stocks. The sentiment, I'd say, was a real mixed bag today. We saw a lot of high-octane speculative interest, but also some very pointed concerns about fundamental risks.
Absolutely, Brooke. It looks like the market is buzzing with some ambitious predictions, especially around companies making big strategic shifts. We've got a lot to unpack, so let's jump right into the tickers getting all the attention. First up, let's talk about Meta Platforms Inc., Meta. This one was absolutely dominating our feeds, racking up an impressive 195 mentions. We saw a lot of chatter about folks buying the dip and some serious insider buying, with over 136% net shares purchased by insiders in the last 6 months. It really seems like confidence is high among those in the know, especially with the news of their strategic pivot towards AI and smart glasses, scaling back on metaverse spending. Analysts are even reiterating buy ratings because of that AI focus. To me, that's a powerful combination for growth.
Well, Ethan, while the enthusiasm is certainly there and the AI pivot is a positive development, let's not forget the recent history. Some users were reporting substantial losses around earnings, feeling zucked, as they put it, with one person going from 140K to 50K in a single night. The current price-to-earnings ratio is around 29, which isn't deeply undervalued. While insider buying is good and revenue growth is at a healthy 26%, the past volatility means this isn't a guaranteed smooth ride. Our AI-generated insights flagged historical stock performance volatility as a key risk.
Fair point on the volatility, Brooke, but with a strong 30% net profit margin and a 32% return on equity, plus the market's positive reaction to the AI pivot, I think the long-term potential here is really compelling. It signals a company adapting and reallocating capital effectively.
It signals potential, yes, but the execution on that AI strategy will be key to sustaining those positive KPIs. For now, given the past investor pain, I'd classify Meta Platforms Inc., Meta, as a cautious buy. There's definitely potential, but it needs careful monitoring.
All right, let's move on to AST Space Mobile Inc., ASTS. This one shot up our list with 90 mentions, with users super bullish about future revenue generation. The community believes they're fully funded to launch 45 to 60 satellites for full coverage in key markets, sitting on around $3 billion cash. There's a lot of conviction in their long-term potential to rival Starlink. People are really looking at the upside here.
Ethan, I hear the optimism, but the current KPIs for ASTS are screaming red flag. The company has a negative EPS of negative 1.14, a net profit margin of 0, and 0 operating margin. This is a pre-revenue company, which means its valuation is entirely speculative. Its price-to-book ratio is nearly 16, which is extremely high for a company not generating profits. While the looming rocket launches are exciting, our AI-generated insights classify this as a highly speculative investment. For now, it's a stay away for anyone focused on current financial health.
Next up, UiPath Inc., Path. This stock got a lot of attention with users celebrating a significant $160,000 gain on recent earnings and touting it as an AI growth play. There's a strong belief in its long-term potential within the AI ecosystem, with many expressing regret for selling early. The recent news of strong revenue growth and their first GAAP profit in Q3 also paints a very positive picture.
Hold on, Ethan. While the sentiment might be bullish, our AI-generated insights raise serious concerns. Path has an extremely high price-to-earnings ratio of 44.0, which suggests it's significantly overvalued based on its actual profitability. Also, its debt-to-equity ratio is alarming at 4.761. And perhaps most concerning, we're seeing significant net insider selling, over 2 million shares in the last 6 months. That's a huge disconnect between user enthusiasm and what informed insiders are doing. Despite the positive earnings news, the financial risks are too high. UiPath Inc. Path is a stay away.
You know, one of the more interesting picks today is Tao Education Group. Tao, a bet on a China policy shift. Users are very bullish, anticipating an easing of the 2021 crackdown on private education. They see Tao as a coiled spring, positioned to become a near duopoly with limited downside and substantial upside. They're already showing a strong 39% revenue growth and a positive net profit margin. Plus, it just got a strong buy rating from some analysts.
I appreciate the coiled spring analogy, Ethan, but let's talk about that spring's foundation. While the revenue growth is impressive, Tao also carries a very high debt-to-equity ratio of nearly 11. That's a lot of leverage for a company whose entire bullish case hinges on a speculative policy shift. If that shift doesn't materialize or is weaker than anticipated, that debt could become a major burden. The PE of almost 40 also means a lot of future growth is already priced in. Our AI-generated insights suggest that while the potential for KPI improvement is there, it's a high-stakes gamble.
I see your point, Brooke, but the fundamental improvements and the strategic positioning for a market rebound are hard to ignore. For me, the potential reward here warrants a closer look.
For Tao, I'd agree it warrants a look, but definitely with a very strong side of caution. Tao Education Group, Tao is a cautious buy.
Next, we have Block Inc., XYZ. There was a bold post about a $100,000 bet on XYZ, targeting $180. While that's an ambitious outlook, the poster clearly sees deep value and future growth in the company.
And that bold bet was met with overwhelming skepticism, Ethan. The sentiment was pretty bearish, pointing to anemic revenue growth of just 2.3% and a high debt-to-equity ratio of 36. User commentary specifically highlighted concerns about stagnant growth, questionable management decisions like the Afterpay acquisition, and ongoing B&P regulatory scrutiny. Our AI-generated insights also noted significant insider selling, which rarely signals a deep value opportunity. Given these fundamental challenges, Block Inc., XYZ, is a stay away.
All right, let's look at SMX, Security Matters Public Limited Company, SMX. We saw some wild discussions around its potential, with a few speculative voices jumping in despite its rough past. Some users are pointing to its initiatives in rebuilding supply chain confidence and transforming physical materials through its plastic cycle token as future potential catalysts.
Even this one is a classic example of focusing on future narratives while ignoring present dangers. SMX has an utterly dire financial picture, an EPS of negative 10,100, zero net profit and operating margins, and a debt-to-equity ratio of over 50. The stock has experienced a massive long-term depreciation, and user comments even mentioned multiple reverse stock splits. While the news highlights innovative initiatives, these have clearly not translated into any form of financial stability. It's bleeding money at an alarming rate. SMX, Security Matters Public Limited Company, is a definitive stay away.
Okay, let's talk about Moonlake Immunotherapeutics. This one sparked a lot of bullish sentiment, with users convinced that the stock is deeply undervalued after a significant drop. They point to upcoming catalysts like an FDA meeting in December and Q4 data readouts, believing their drug, sonelokimab, has strong efficacy across multiple indications. There's a lot of excitement about a potential re-rating.
Ethan, that excitement needs to be tempered with reality. Despite the bullish sentiment, MLTX has an extremely high debt-to-equity ratio of 26, negative EPS, and no profitability. Furthermore, our AI-generated insights show massive net insider sales, over 6.4 million shares sold in the last 6 months, despite a recent small CFO purchase. Plus, RBC Capital Markets reported limited effectiveness of their drug in recent trials, which directly challenges the core bullish thesis. These are significant red flags that outweigh the speculative catalysts. Moonlake Immunotherapeutics, MLTX, is a stay away.
Shifting gears to Safe and Green Holdings Corp., SGBX, there was a lot of chatter suggesting a massive short squeeze, with calls for the stock to hit triple digits. Users are seeing technical indicators like a starved float and FTD pressure as signs of an impending snap upward. Their subsidiary, Olenox Energy, is also making positive operational strides with an aggressive drilling agenda and AI implementation.
Ethan, that triple digits prediction is pure fantasy when you look at the fundamentals. SGBX has an astonishingly negative EPS of negative 244, a staggering debt to equity ratio of 48.9, and negative revenue growth of 40%. The company is essentially collapsing financially. While the Olenox news sounds good operationally, it has not and likely won't soon fix these catastrophic financial metrics. Betting on a short squeeze here is incredibly risky. Safe and Green Holdings Corp., SGBX, is a stay away.
And finally, Beyond Meat, BYND. This stock showed up in discussions about potential meme rallies. While some are avoiding it, there's always that underlying speculative hope for a short squeeze, given its volatility. Interestingly, our data shows a significant net purchase of shares by insiders in the last 6 months, which could hint at a future turnaround.
Ethan, with all due respect, hope is not an investment strategy. BYND is a fundamentally distressed company. It has deeply negative revenue growth, deeply negative net profit and operating margins, and a negative price-to-book ratio, indicating liabilities exceeding assets. Our AI-generated insights classify this as extreme financial distress. While insider buying can be a positive signal, in this case, it's against a backdrop of truly dire KPIs. Relying on a meme rally here is incredibly risky. Beyond Meat, BYND, is a stay away.
All right, let's finish with Warner Bros. Discovery, WBD. This one was all over the news, with reports of Netflix making a $28 to $30 per share bid, even entering exclusive talks. Users were seeing this as a free money arbitrage opportunity, given the stock's current price around $24.50. It's an exciting potential acquisition play.
Acquisition speculation can be thrilling, Ethan, but the underlying company's KPIs are abysmal. WBD has an extremely high PE ratio of 129, negative revenue growth, and an astronomical debt-to-equity ratio of nearly 90. If this deal, for whatever reason, doesn't close at the rumored price, shareholders would be left holding a company with massive debt and declining revenues, currently trading near its 52-week high purely on speculation. The user sentiment itself had a strong undertone of skepticism about the news. It's too risky. Warner Bros. Discovery, WBD, is a stay away.
All right, that was quite the deep dive today. Let's quickly recap our AI-generated insights for Friday, December 5th. Investigate as buy, none. Investigate as cautious buy, Meta Platforms Inc., Meta. TAL Education Group, TAL. Investigate as speculative gamble, AST Space Mobile, ASTS.
And that's our take for today. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to The Daily Hunt for Multibaggers. Have a fantastic weekend, everyone, and happy hunting.